Hi, everyone. Thank you so much for joining us on our market update. We normally cover the Houston area, but this time we're going to be branching out into all the areas that we service. Since we have some new people that have registered with us, joining us from Facebook groups from Austin, San Antonio, and Dallas, we're going to cover Catalyst a little bit more instead of waiting for our normal 2-minute start time. So if you're joining us a little bit later, again, thank you for joining, but you will get a copy of this webinar so you can go back and review later. So I want to talk a little bit about who we are before we get started. Catalyst Funding, we're your one-stop shop for hard money and permanent financing loan. Our company was built by real estate investors. We've been involved in over 1,000 deals. We are super proud to be advisors, and we love working with you directly. You will enjoy a single point of contact for all your loans. A fully licensed loan officer will be dedicated to your success and work with you to find the right product for your needs. We don't offer one size fits all, and we work diligently with you to narrow down the right product for your loan needs. If you're interested in learning more about us, we're going to be on the call so you can ask us questions at the end, or you can email us at info@catalystfpg.com, or you can always call our sales line, which is 832-699-6960. And if that was too fast, don't worry. The last slide will have all the contact information on it as well. We are going to talk a little bit about our products. I'm going to hand that over to Jeff.
Thank you, Destiny. So like she was saying, we are a hard money. And first off, I wanted to say thanks for you guys that are joining us. If you are in one of the markets that Destiny mentioned, we are excited to be moving into Dallas, San Antonio, and Austin. But we are a hard money lender and a conventional lender. So we give you money to purchase and repair properties. If you want to flip it, then you buy it, fix it up, and sell it, and that is the end of the transaction. If you want to buy it, fix it up, and refinance it, we can handle both of those deals. And we have a lot of products designed for the buy and hold investors. Very unique that we don't think any other lender can offer. So we can do conventional loans. We can also do non-conventional loans. So for those of you that are really experienced and have already maxed out your number of conventional loans, we have very well-priced alternatives for long-term loans, one of which is a 30-year fixed, no income doc loan. So you don't have to provide any income documentation. You get a full 30-year fixed. We're doing a lot of cash out deals right now with real estate market being where it is. A lot of folks are pulling cash out of either their primary residence or their investment properties and using that cash to buy more properties. Let's see, non-conventional options. Like I said, that we do have a non-conventional product that goes all the way down to 500 FICO. Our hard money loans for buy and holds, they start at 6.99 and 2 points. And then we have a VIP flipper program. And we do flips for people, even if you don't qualify for the VIP program, but for the VIP folks, the rates start at 9.99, and we can even do as few as 1 point.
And one other quick thing to add to that, we do this in Houston currently, and we will be doing it in the not too distant future in San Antonio, Austin, and Dallas, is we do provide wholesale opportunities. So if you are interested in getting attractive off-market deals, please sign up to be a part of our, either follow us on social media or part of our email group. We will send out not only those wholesale deals, but also value-added content, interesting articles, and other things that I think will help you enjoy and succeed in real estate.
Yeah, and just one last thing, we typically try and send those wholesale deals out to our pre-approved people first. So if you are serious about wanting to do real estate investing and you want to get started or you want to work with us, give us a call, go to our website and apply, and that will get you in line for first dibs for our deals, which are happily increasing quite a bit lately. So very exciting stuff.
All right, thanks guys. So you've just heard a little bit from Jeff and Wade, but let me tell you a little bit about them for those of you that are joining us for the first time. Wade Como is our founder and CEO. Wade has over 25 years of lending experience managing with large reputable companies. He's held titles such as president and vice president, leading sales and operations team of up to 1,400 employees at a time. He's a licensed mortgage loan officer, real estate agent, and active investor himself. Wade is passionate about helping his clients achieve financial freedom through real estate, and that's one of the reasons we do these webinars. Jeff Johnson is our Director of Lending. Jeff manages all lending operations with Catalyst Funding to provide excellent and reliable customer experience. He is a licensed mortgage loan originator himself with over 20 years of lending and sales management. In working with large companies such as NationStar, Morgan Stanley, and Ames Home Loan, that's to name a few, and he has held various leadership roles, including regional vice president. So these are the gentlemen you're going to hear from today, a lot of experience, and if you have any questions, again, feel free to ask them in the questions box or write into the chat panel on the left or right-hand side of your screen. Before we jump in, we are going to go over the disclaimer. This presentation is for general information only. By attending, you're acknowledging and agree that Catalyst Funding and or its agents do not assume or hereby disclaim any liability to any party for any loss caused by the information contained here. There's a little bit more on the screen for those of you that aren't currently looking, but that's the gist. So we'll go ahead and get started with our September 2020 market update. I'm excited.
And I do want to say thanks to Destiny. She put an incredible amount of effort into putting this information together. In the past, we've covered Texas, national information, and then also Houston primarily, but we really worked diligently to find the best data sources for information in these other areas. So the way we're going to cover things in sequence today are first national information, then all of Texas, then we're going to go through all of the major metros throughout Texas individually, which we think will provide everyone a very good overview of what's going on, not only in their local market, but regional and national. This first presentation is actually what's called the Fannie Mae Home Purchase Sentiment Index. So this basically is a measure of people's optimism regarding selling properties or buying properties. And in August, the optimism increased 3.3 points to 77.5, reaching the highest level since May. For those who think it's a good time to sell, there are more people that think that than do not. But most importantly, I think for buyers, if you're going to be looking to flip properties or just an overall indication of where the market is going, 59% of people reported it's a good time to buy, with fewer feeling it's a bad time to buy by a pretty large margin.
Yeah, so like I said, that is the highest it's been since March, which is basically once COVID happened. So it's good to see things getting back to where they were before the pandemic. So this is from Realtor.com and Remax, some very interesting stuff. So national inventory has declined 36% year over year, and inventory in large markets has decreased by 38%. That is a huge number. There are just not as many properties available for sale right now. And I read a couple articles that had some thoughts behind why that is. We can get into that, but let me finish the slide. Inventory of newly listed properties declined by almost 12% nationally over the past year and 11% in large markets. This last stat's crazy. Home sales in August 2020, month supply of inventory decreased to 1.7. That's across the country. That is an all-time low. So there have never been fewer houses for sale than there are right now, right? Or relatively speaking. So I was looking at an article on, and it was kind of trying to figure out why inventories are so low, and they really had four main points. One, the number of first-time home buyers, millennials, right? The people that are in their late 20s, early 30s. I think I read something a few presentations ago that said that was the largest population group of all time, and they are hitting their sweet spot of wanting to buy properties, the first-time home buyers. So they're hitting that age right about now. Rates are at all-time lows. So you have this, it's just easier to afford a home, or if you can't afford a home, it's easier to afford more home. So people are excited to buy houses at really low rates. The forbearance rules are keeping people that maybe are unemployed and would be having a hard time staying in their houses from staying in their houses, right? The foreclosures aren't really happening as much as they could be because of the forbearance rules. So that's less inventory. And plus just coronavirus in general, people are less likely to want to show their homes. They just are not as likely to let people into their house. So when you factor all of those things in, it gives you a 1.7. And so that is a really low number.
In my opinion, there are two other things that may even be more impactful than that in some ways. One is that I think there's a real desire to move to space. I've read several articles about that. It's also my feeling that if you think about it logically with what's going on, people are less likely to go to public venues or to take advantage of an apartment complex, swimming pool and or park, or even exercise facility, you know. And in apartments, you don't have a yard, and you often don't have a deck or any private areas. And in single family homes, you do. So I think there's a lot of migration from apartment complexes or upward living in townhomes, condos, things of that sort to single family properties. And then another thing that I think is real is that a lot of people are seeing these rates that are so incredibly low. People that have been long-term tenants in any environment are seeing an opportunity to buy, right? So maybe they've been in apartment complexes for a long time. A lot of these millennials have been like, I like the urban living, but they're seeing an opportunity to buy at such low rates that there are instances where it can be more economical to buy a home than even to rent at this current moment.
And I think their age has a factor too. The average is 32 for millennials right now. And so I think that's a good time for a lot of people starting families. And so they're going to need space for that reason as well.
Oh, there's one more thing that I remember a couple presentations ago, that it's basically that new home builders, relatively speaking, have been building less over the last 10 years than they have since like the 1950s. So they just weren't building homes.
Market update.
Yeah. I know they're trying to catch up, but they just can't keep up.
Yeah.
I was gonna say, so if anyone missed that, we have it on our YouTube.
Yes, that was a Destiny. You could give a Destiny on getting former article. This supply and demand ratio, and like anything else, whenever things are in short supply, it really makes a huge difference. And what we're going to hear is an overriding theme in almost all these areas is that demand is high and supply is low. And that's why we continue to see huge price increases as well.
Yeah.
So this is data from the National Association of Realtors. It is July data. A lot of the data that we're going to cover today is August data. This is a little bit older, but we did think it was still important because it was this particular organization seems to present their data a little bit later. But the median existing home price for all housing types, that includes single family, that includes condos, townhomes, things of that sort, was up 8.5% from July, 1 year earlier, as prices rose in every region. So consistent across the entire country, 8.5% in 1 year. That is a really big jump. And then total home sales jumped 24.4%. From so that's just a really big jump as well. So a lot of data indicates not only that there are a lot more home sales in general, but also each home is selling for more money on average and the median.
Now we're getting into taxes.
Yeah, I'll take this one. Feel free to jump in, Wade, whenever you see fit. So this is Texas July data. This came from the Texas A&M Real Estate Center. They do a really good job of aggregating a lot of data. So this first little quote was pretty interesting. Every major metro, this is July, not August, but every major metro posted a historical number of sales, rebounding fully from sluggish activity earlier this year amid coronavirus concerns. So every major metro basically had a record in July. Think about that for a while. Total Texas housing sales rose 17% in July, exceeding pre-pandemic levels with a record-breaking 36,000 sales. I think all the things we've been talking about, one thing we didn't talk about really was the glut of mortgages that started to get closed. It's just taking a lot longer to get mortgages done these days because so many people want to refinance. Supply side activity bounced back with large increases in building permits and housing starts. Anecdotally, I have a friend of mine that works for a home builder, and he said they cannot keep up with demand. And part of it is because of the coronavirus, like the facilities that produce the materials that they need are working at lower capacities because of social distancing. So they literally can't fill the orders fast enough. So that's just going to mean rising prices. Inventory levels continue to trend downward, falling to an all-time low of 2.6. That's in Texas. Inventory for homes priced less than $300,000 is even more constrained, sliding to less than 2.1. So if you want to buy a house for less than $300,000, it is that much more difficult to find one. The MOI for luxury homes, priced more than $500,000, remained higher at 6.7 months, despite dropping for the second straight month. The Texas median home price surged to $261 in July. That is almost 10% year over year. So when you think about investments, right, real estate, if you would have bought a property a year ago, you would have had your value increase almost 10% in 1 year. And lastly, Houston and Dallas-Fort Worth issued 4,900 and 3,700 non-seasonally adjust permits. That is the peak level since the Great Recession. All right, so all things pointing up in Texas.
I have nothing to add on this, so we can.
Okay.
That was very.
The only thing I would add on this is it's July, but this data actually came out 3 days ago. So it is the most current that's available for Texas right now from this report.
Okay, so Houston is going to be the first major metro that we cover. This is August data, a little bit more timely. And you can see here that July was a record month in almost every statistical category. Then August proved to be another very strong month. Some really good data here. 9,195 single-family homes sold, a 6% increase over the same time in 2019. Home prices at the 750,000 plus price had the greatest percentage increase at 40.3%. So that luxury market where, I think Jeff had a similar thought early on. We were concerned about how the luxury market might do in flipping properties, and every month that we think it might turn a little bit differently, it just continues to do extremely well historically. So a lot of flippers are doing quite well in all product types. Although I will say I still continue to believe that that is the area that can turn the most quickly if things were to turn in the market. So that's something that we always encourage our flippers to be aware of, and that's a price point where it is important to be well capitalized to make it through potentially a little bit longer hold if you're going to have to do that if the market turns a little bit. But even this other 500 to 750 jumped 34.4% year over year. The $500,000 range had the highest sales volume in that range historically. And then where the rubber meets the road, single family home median price climbed 7.6% compared to this time last year. Year-to-date sales, that includes the time when things were really slow at the beginning of the pandemic. Still year-to-date overall, ahead 2.8% over 2019's record numbers. And then sales of all property types totaled 11,121. That's all single-family types, condos, townhomes, etc. Up 7.3% from August of 2019. And the total dollar volume was also up 13.4%. So strong numbers across the board.
All right, so year to date, home sales, I think it was on the previous slide as well. It says home sales are running almost 3% ahead of 2019. Total active listings fell 23%. That's what we're talking about, right? That is the biggest piece of news, or one of the biggest pieces of news. There just aren't as many listings now as there were last year. Days on market for single family homes lowered from 53 to 51, which is it's a couple of things. It shows market appetite, but it also shows, honestly, mortgage processing times as well. So when everyone wants to refinance, it constrains the system and things slow down a little bit. So that is a factor for that number for sure. Leases of single family homes fell 13% year over year. I guess my only takeaway from that is people are wanting to buy homes, right? So you're going to have, I'm guessing, fewer leases.
I think another factor there, Jeff, may be that people are also less likely to change rental properties, even if they're renting. I think people are staying in their properties, extending at a higher percentage. Anecdotally, within our own portfolio, and other data I've read is that people just feel comfortable where they are at the moment. If they like that property, a little bit less likely to try and go out aggressively and look for something else if they are relatively happy.
And this number seemed high to me. I did not realize it was as high in Houston, but the average rent for single family homes was almost $2,000 a month. I mean, that's pretty high. So it's great for landlords, right? That number, if that number keeps going up, that's great for landlords. There's a lot of rental properties you can get that are they're going to cash flow nicely at that $2,000 a month. This chart here, it kind of shows the entire picture of what we were talking about on the previous slide with which brackets are doing well. If you see the bottom two brackets, there's 0 to 99 and 100 to 150. So basically anything 0 to 150, those numbers are significantly down. I think it's just harder to find properties in those buckets is the main reason. It's just as prices rise, you have fewer deals that are available at that number. 150 to 250 is pretty flat, but then like we said earlier, once you get 250 to 500, 500 to 750, and 750 above, basically everything from 250 above is up significantly. And that just kind of goes to what we were talking about earlier, just rising real estate prices in Houston. I read an article about people leaving the coasts, and Texas is a big destination for that. So I think it's going to keep happening as the quality of life here is pretty good, in my opinion.
Low tax rates are also a really big thing for Texas.
Yeah, sure.
Okay, this is a chart we show every time, and it is a comparison on many numbers from same time last year. This is August data, a little bit more timely. You can see total property sales year over year, up 7.3%. Active listings down 23%. The sales up year over year by 6% in single family. That's excluding some of those other properties like condos, townhomes, etc. Average price up 7.8%, median price up 7.6%. And in this single family months inventory, it's actually a little higher than in some other parts of the country, but still historically low. And we haven't mentioned it yet today, but 6 months is considered in balance, right? Where there's a relative balance between supply and demand. And there's not a single part of the country that's anywhere close to 6 months that I'm aware of. No major metros are. I think we saw the national number 1.7. Here in Houston, 2.8. I think throughout Texas, it might have been 2.3. So far lower than equilibrium or balance. Definitely fewer homes than people who want to buy them.
I think historically speaking, we are significantly higher than the national average. And I would not be surprised in the next 2 to 3 years if that number gets down to closer to the national average. I think we're gaining on the national average. And to Wade's point, as far as explaining what that number means, that basically means that if no other properties were to hit the market, it would take 2.8 months for every house to sell. We'd be out of houses to sell in less than 3 months if nobody else listed anything. So this is a kind of a historical chart. It's Houston. It shows the average and median prices. If you were to go back 5 years, it looks like the average price was right around 280 5 years ago. And like it says right now, it's up to 335. And I think the median price is probably in the 215, 212 range, and that is up to 269. So, not a lot of shockers here. Buying real estate over the long term is a good investment. I do love the dips that we see. You see those massive, but you see the pretty significant dips. So if you're an investor, buy in the wintertime because you can get a better deal.
On to San Antonio.
Yes, nice photo of the Riverwalk. So some really good stats here as well. Home sales this year at 24,745, which is a 5% increase. That's year to date, right? Compared to the same time year to date in 2019. So a 5% increase overall, as we mentioned earlier, including a time when things were legitimately slower at the beginning of the pandemic. Median price up 9% year over year. That's August to August data. Average price measured an increase of 12% from January to August. San Antonio's average price of a home increased by 12% this month compared to August of 2019. In August alone, single-family sales were a 7% increase over 2019. So that's different. Again, we're talking about overall homes and then single-family homes. Average days on market at 53 days. I think I saw Houston may have been at 51. Rent prices at $1,300. So significantly more reasonably priced than the average number in Houston. And the average months of inventory is at 2.8, which is right in line with Houston. So historically low and very below equilibrium or balance. So it's definitely a seller's market.
So this next slide is kind of quantifying a lot of the things that Wade was talking about. I do think it's pretty cool that they have the 2018, so you can really see a little more broad time spectrum, right? So total sales are up 7%. The average price, you know, if it looks like from 18 to 19, it was a modest 4%, but look at that jump from 19 to 20, you know, almost a 12% jump. And, you know, I was looking at Houston versus San Antonio, and I always assumed that Houston was significantly higher than San Antonio, but not really, right? I mean, San Antonio is at 310, right? And Houston is what, 334? So it's not that far behind Houston. I was surprised, didn't expect that. Median price is 259, excuse me, 259. So that has gone up. Like I said, again, in 19, there wasn't much of an increase, only $7,000 increase, but in 2020, it's gone up quite a bit, you know, almost $20,000.
And we covered some of these statistics down below, but year over year, still strong numbers. This is a great chart here. Thank you, Destiny. You read my mind to go to this one. So this just shows the average home price increase courtesy of Zillow. And if you look at 2011, a little bit of dip in 2012, but a rapid increase consistently through this time frame. And it looks though, and it's a little bit difficult for me to tell exactly what the number was at the low there in 2012, but maybe 125, 128, something like that, and then we're up to 184 in that time frame, like 8 years. So, and almost a 50% increase over that time frame. That was obviously you would have bought a property back then. That is a fantastic investment, and we have seen, you know, it does seem to forecast a bit of a dip here. I'm not sure exactly what they're baking into that. It may be concerns of potential foreclosures that may come up, or whatever the case may be, but that would be counter to the 8-year trend, and also counter to the supply and demand numbers that we see in place today.
That's a pretty nice little straight line. You know, you don't see, there's no dips. It's just very steady and straight. Very, very little up and down, you know. So Dallas, this is, most of this data is from Metro Tex. So the Dallas housing market has recovered, right? Like all the others. Number of homes sold in Dallas County was 9,900, which is a 20% increase over last year. The median sales price was up 2% to 286. And so, you know, like to compare to San Antonio, median price 259, Houston median price 269. So currently Dallas is the leader in the clubhouse with 286. Average home value 226. That, I don't think that's right. The average home value in Dallas, I think that's a misprint. We can go back and check that data. That does not seem right to me. But the average home value in 226.
So on that same report, it had that as the average home value, but the average listing was in the 300 mark. And then it had average sales roughly around that as well.
I think, unfortunately, Destiny did a good job trying to make sure that we had the same data for each category. But sometimes whenever you go to a different data source other than like the Dallas version of HAR or their national association or their local association of realtors, I tend to agree with Jeff that I'm absolutely sure on that number. since it's not directly from that group.
Yeah. I'll try to find it while we're talking. Closed sales increased by 21%. Months of inventory down to 2.7, which makes sense. That's about where we should be. Total days on market was 75, 3 days more than July of 2019. And the median rent in Dallas was $1,700.
Yeah, and to just point out, keep in mind with days on market, I do think a major driver is not necessarily the marketing time, but the mortgage time. Mortgage times are up about 50% prior to massive rate drops. So I think that is a big driver there. Average days on market to get under contract is actually lower in all the Texas markets, including Houston and Dallas. It is taking a lot more time to get through the system. Part of the next slide. So Austin has definitely seen upward trends in many categories as well. If you look at the median sales price, definitely the highest of all of the Texas markets, which is not surprising, $355. Total number of sales up 12%. Average days on market down 10 days. And that is by far the lowest number of all the major metros. Every other area has been in the 50s. Austin is in the 40s, which to me it tends to say that I don't think that they're just closing mortgages more quickly. I do think that where that number is reduced is the days to get under contract. I think that is the leading indicator on why that number would be so much less. I told you it's an even hotter market than some of the other areas. Average listings down 44% year over year. That's an amazing number. Active listings, sorry, not average. And pending sales up 40%. That cannot continue forever because I think unless listings really start to increase, those pending sales numbers are going to start to decrease. There's no way that it can continue to work in exactly that way. Sales volume as a amount of dollars, 1.88 billion, up 35%. And then the months of inventory, this is the lowest of any of the markets that we've seen in Texas at 1.4 months. That is still slightly above, I think, the national number, but no, national number is 1.7.
1.7 is really right there. Yeah.
But that's way below the other Texas.
Oh, yeah. That's
a very, very hot market there in Dallas. Sorry, Austin.
Yeah, and I was able to find on Dallas because one of the numbers didn't look like it jived. So in Dallas, actually, the days on market is 40 days on market with an average. The 74, I believe, was including the closing. So Dallas is on market, it's not 70, it's like 40, which is more in line with what I would expect in Austin.
Okay, I don't think I have anything else huge to cover on this page. Do you, Jeff?
No.
I went back and pulled the national from the earlier part of the presentation. It's 1.7 for national, so this one is the closest to that, and it's just under. But this information actually came out today, so this is really exciting information to have. And before we move on, we have a few questions for some of the metros. You guys mind if I ask those now?
Perfect.
Okay. So this one is for the Houston area, and this is from John. Which Houston areas are going to trend well for the remainder of the year / trended well this year so far?
You know, we do not break those numbers down with that much detail by towns, parts of Houston. I can tell you that I have read quite a few things in Houston and in other areas. There is a move to the suburbs for a wide variety of reasons, more space, many other reasons. So people are getting out of things that are built vertically or very tightly compacted into areas that have more space. So I do think that trend is going to continue.
Okay, thank you, Wade. And this one is going to be from Henry. What is your speculation on why oil and gas isn't impacting the housing market?
Well, I think that while there have been a few jobs lost in oil and gas, I don't think it's been as profound as one might have anticipated. And Houston is a much more diverse economy than it was in the 1980s, whenever the oil and gas crisis severely impacted real estate prices. We're just much more diverse today than we were back then. And I think even with some job losses in oil and gas, the overall housing market, because of all the factors we've talked about earlier, is just outrunning any impact that might have. I mean, there's just, with low interest rates, desire to move to areas of greater space, a lot of people moving in to Houston from the coast, areas with, higher taxes, bigger challenges, than we have here. I think that trend is just going to continue. And unless there's much more severe impact from oil and gas job losses, I don't think it's going to run the other positives that are causing Houston real estate to still do well.
Yeah, I agree. All the factors I talked about earlier with the shortage, why prices are or inventories are staying low, so they're propping up prices. Plus, when you factor in all of the people moving from the coasts to Texas, I don't want to say it negates it, but it seems like it's pretty close to just wiping out those losses right now and keeping real estate prices basically where they are.
Awesome. Thank you, guys. Linda, I see your question, and we're going to hold this one until the end. Thomas, I'm going to use your question as a transition to our next slide because it's an excellent question. What is the plan after December 2020 for the CDC moratorium? And that's one of our hot topics. We have 2 hot topics we're going to be covering next. Gentlemen?
Yeah, so we'll go on with the CDC moratorium. There is no communicated plan for what happens afterwards. The plan currently is that there is an eviction moratorium for people who complete a form that says that they have been adversely impacted by the coronavirus. There is an expectation that they document some of those things, and we do not know exactly how that is going to be executed by those local municipalities and the people who are going to be making those decisions. But a consensus is that for the most part, there just are not going to be evictions until after January 2021. Now, that does not mean that those rent payments are waived and that they are not accumulating. So most people who care about their credit and who do not want to have a massive one-time payment that is required are really making efforts to continue making payments, even if they may be slightly reduced. Anecdotally, in our portfolio, delinquency is under 3%. And nationally, the numbers I see, depending on the estimates, are somewhere under 8% typically. So we're not seeing a massive problem with this, but the people who are not paying, both anecdotally and from what I see from some of the data, they're just not paying at all. Unfortunately, even though they may be getting some type of other governmental assistance in the form of enhanced unemployment, extended unemployment, additional payments, if they are not paying, many people are just not paying at all. And then other people are at least making a partial payment every month, and then some people are making full payments. In my opinion, as far as investing in real estate, how does this affect investors? If you already have investment properties, I think if you were doing good rehabs, putting out a quality product, treating your tenants well, making repairs, and you had a good tenant base, the delinquency is relatively low. It's a lot worse for people who are not in that higher quality home and in higher quality tenant category. But from what we've seen thus far, most of the landlords have been able to manage through that because the delinquency has not been that high. Most people are at least making partial payments. So if you're going to put a new property out today, thus far, unemployment seems to be trending down steadily, which is a good thing. And I think most people that would have lost their jobs would have already lost them. So if you are out looking at new potential tenants today, while they could lose their job, I think the odds of that happening are far less than they were back in March. So the way I am looking at it, we are investing in properties. We're going to be closing on one in the next few days. I believe that although this moratorium is in place, if you're bringing a new tenant on, the expectation would not be for them to stop making payments in the next 3 months. You're doing a good job of evaluating them, ensuring that they have a quality job, that they have the ability to make their payments, that they have a good credit history overall, and they seem like they have good character. Then I don't know that this is going to affect. Now, we don't know what happens after the first. I can tell you that you cannot go forever expecting landlords to continue to make mortgage payments and tenants not having to make payments. Like, that's not viable in perpetuity. I don't know exactly what the answers will be, but I do think there's going to have to be a point where they're going to have to let some of these things settle out, both in the forms of foreclosures and unfortunately in the forms of evictions. I don't know exactly what timing that will be, but I think we will eventually start to see some of that. And hopefully, over time, we're going to see the coronavirus situation stabilize and even more people get back to work. And some of these businesses that often some tenants are employed in that are more of the gig industries like restaurants, bars, et cetera. Whenever those things start to open up, I think it will improve. And there have been quite a few states where it has opened up, and unemployment in those states where the lockdowns have not been as extended or severe, unemployment is significantly lower in those states. And Texas is one of those.
Yeah, I was reading something about what it takes to qualify for the moratorium as a renter, and it's not a large chunk of the population that's going to qualify. And there are, if I'm not mistaken, there are some penalties for falsely claiming that as well. So I wouldn't expect a huge number of people trying to falsely get by on not paying rent. Plus, like Wade said earlier, I would say the biggest thing moving forward is really vet your tenants, right? Spend a lot of time, make sure you go through the process of trying to get the best quality tenant you can into the property, especially now with everything that's going on. I would take a little extra, make your standards a little higher, I guess is what I'm saying, before you stick somebody in that property.
All right, we're getting into the Fannie and Freddie refinance fee.
Yes, so that came out, and it was initially announced with a very minimal heads up, basically. I would say they announced it and they said basically this is going to kick in 15 days. There was a lot of pushback on that, and that date to kick off this fee has been moved back to December 1st. So that is when Fannie is going to charge the lenders an increased fee. Lenders, of course, have to pass on that fee to the borrowers themselves. So you do need to check with the individual lender and make sure you understand when their cutoff is for that additional fee. So in other words, you will need to close with most lenders on a date earlier than December 1st because they have to package up that loan and get it to Fannie to be purchased. So I think you need to understand the timing with your individual lender, but I would encourage you to try and get any refinance transactions completed in advance of November if possible, and then just to understand the implications beyond that. If you are a person who's doing buy and hold investments, like if you're a landlord, rates are historically low that even with a half-point add-on, while frustrating, and I recognize that, they're still so much lower than they've ever been. Your cash flow and all your return on investment numbers, cash on cash, everything is so much better today because of these historically low rates, even with a half-point add-on. It's really just like a mosquito on a warm summer night. It's like really not that big of a deal, and you should still continue to invest with no question.
Like a mosquito on a warm summer night. That was pretty funny.
Yes. Frustrating.
We are finishing just a tad early. We do have quite a few questions, but if anyone on the call has additional questions, please feel free to write in on your questions box. It should be on the right or left-hand side of your screen. If you're interested in speaking with a loan officer or talking to us more, feel free to write down this contact information here. Our sales number again is the 832-699-6960, and that'll actually get you in touch with one of our loan officers. Our email address is info@catalystfdg.com. That's info@catalystfdg.com. And of course, add us on social media so you don't miss any of our upcoming webinars. You will receive a copy of this webinar because you registered, so we want to thank you in advance for joining us again. So some of the questions that we have, I'll go ahead and go down in order. Linda had asked this question earlier and starts out with, I'm new. As a beginner, is it smarter to flip a property and repair one to keep it as a rental, or to try to find one and rent it out? I think like wholesale is what they're referencing.
Can you repeat that one more time?
Yeah, I am new. As a beginner, is it smarter to flip a property or repair one to keep it as a rental? Oh,
So
I think we just flip it or, yeah.
you started with a flip or a buy and hold.
Mhm.
I really think, and Wade, feel free to chime in. I really think it depends on your long-term goals, your short-term goals, and your cash position. Because most people that I run into in this business, most of them want to be long-term investors that want to hold properties as rentals. It's a I think we mentioned it a couple of times, but by the time you retire, if you just have one paid off property, I think you're ahead of the majority of the population when it comes to retirement funds. So most people want to have long-term wealth and long-term cash flow by doing rentals. So the thing about rentals, though, is that unless you are sourcing them yourself, meaning you are out there finding deals actively from sellers, you're going to be buying them from agents, wholesalers. You're not going to be able to buy those properties continuously without spending some cash. The usual amount of money for a buy and hold deal is somewhere, if you get a real steal and you get lucky, you can get them in the high end of teens, as opposed to sometimes you're in the mid 30s, and it just depends on what you are looking for in the deal, and it can make sense both ways. But it takes money to buy rental properties typically. So if you have a large chunk of cash and you can deploy that cash to buy rentals, I would start with rentals. If you do not, and you want to accumulate rental properties, a lot of people that we work with, they will flip a property, take that money, say they make $20,000, $30,000, they will use that to go buy a rental property. As far as if you're brand new, and your cash position should dictate what your goal is, and then your cash position should dictate how you do it. Do you have enough money to start buying rentals, or do you need to replenish your cash with flips? That will decide that. But as far as finding deals, if you're newer, we really recommend sticking with lighter rehabs, something a little simpler. Don't dive into the $70,000 or $80,000 rehabs where you're getting permits and rebuilding a property. Stick to something a little cheaper and a little more cookie cutter, to where you don't really get into trouble. You get your just first deal and you move on to the next. You live to fight another day. Wade, I don't know if you have any suggestions.
Yeah, I think that you very well described most people who are full-time employees. I do think that there's a different segment of the population who are wanting to be real estate investors full-time. And it's very difficult to be only a buy and hold investor full-time in perpetuity. Because to your point, buy and hold investments are a long-term play, and in the short run, they cost money. They do not make money in the short run, because you're putting out 35,000 and 25,000 on average probably. You may only make 300, 400 bucks a month. It's a great amount of money, and you do have equity capture at close, but that equity capture is not in your pocket, right? It's held in the home. It's not cash. It's not liquid cash that's available. So we do have a lot of people who want to make real estate investment their full-time career. So they will flip several houses in a year. And on the average deal, people typically make, even if you're only in the $350,000 ARV range, they're usually making 35, 40 grand. And, there's a lot of people out there that don't make 35 or 40 grand, or definitely don't make 80 or 120. So between 1 to 3 houses, you might be able to do that full time. Now, that's not an easy business. There's some complications. I don't want to make it sound like it's not a challenge, but there are people that we work with who do that as well. So that's the only other nuance I would give to that. But my encouragement, and like many mentor out there would encourage you to flip a house while you're employed, make sure it works well, that you have the skill set, and that you see the vision for it before you leave your other job. That's a much better alternative than just saying, I'm leaving corporate America and I'm just going to become a full-time investor, and you haven't even tried it. We would strongly encourage the other path first.
So if you want more detail, Linda, give us a call and we're happy to talk to you.
Yes.
That's true. We got the number right there on the screen. All right, we're moving on. This question is great. This one's from Anthony. When do you think Fed rates will start to rise again? Great question.
I don't remember how many months ago it was. I think it may have been 2. But I think the Fed chairman, Jerome Powell, said we have no plans to raise rates, which is a pretty strong statement, and that's usually a leading indicator. Unless, in my opinion, they have always used the housing market to prop up the overall economy. Like that's a consistent plan, both in buying bonds and in lowering interest rates. So in my opinion, that's going to continue until the economy really starts to turn around. I do think it will increase over time. I mean, they are historically low, like never happened type low. So it has to go up some. Do I think it's going to be back on like a owner occupied mortgage to 6% in the near future? I really do not. I think if it is going to increase, it's going to be a very gradual increase to not make any seismic shifts take place in the housing market or in other parts of the economy. I don't anticipate that even the smallest of increases strategically happening for some time. That does not mean that interest rates will not increase. I think that they will move without the Fed's intervention, but I don't think there's going to be any strategic changes made intentionally to increase interest rates for some time.
It's a very timely question because I thought I saw this headline yesterday and I just found it. Per the New York Times, the Federal Reserve's latest economic forecast suggests that interest rates will remain near zero at least through 2023.
Now, keep in mind that
rates will go up.
It's not mortgage rates. That's the
Right.
interbank lending rate overnight. So that is very different. So sometimes people hear that near zero and they think that's what mortgage rates are, and it's two very different things. But to Jeff's point, that is a leading indicator that does kind of flow through to the rest of interest rates.
It broke up. Did you say 2021 or we didn't hear the year? 2023.
Jeff, I
Wow.
think you may be on mute or something.
Yeah, it sounds like you're far away.
Hello?
There we
Hey,
go. You're back, man.
glad to have you back.
2023. Sorry.
You're back. 2023.
Yes. Almost say it loud. Proud.
And I did find that quote just since we were on the topic. We're not thinking about raising rates. We're not even thinking about raising rates. Fed Chairman Jerome Powell said, what we're thinking about is providing support for the economy. We think it's going to take some time. So I did find that to go with what you were referencing earlier, Wade. All right, moving on. This question is going to be, oh, sorry, the lights are motion censored in here. I have not been moving enough. This question is going to be from David. It says, I want to do a hard money and do a hard money to rental property. When can I get a tenant into the property? Do I have to wait until the hard money loan refinances? I'm going to try to fix the light in here.
Well, there are some lenders that require you to have the property leased before you do refinance. Fortunately, we're one of the companies that does not require that, so you do not have to have the property leased before you can refinance with us. But typically, you do wait until the property is completely remodeled because it's not really wise to be doing construction while someone is in there unless the repairs are lighter in nature. Like we do sometimes ourselves purchase, and we sometimes will wholesale or provide off-market opportunities to people with tenants still in them. And you can make some major repairs just like you would in your own primary residence. It's just not as easy with someone in them. So the typical process is buy a distressed property. You're going to get your best deals on distressed properties because they are not in perfect condition, and because a typical end buyer who's not an investor and looking for a discount, you're not competing against them, right? So those are the best deals. You can use hard money to purchase and repair that property, and then you can refinance out into a conventional or non-conventional loan. And for our conventional products, for us, the property does not have to be leased, to recap.
Yeah, you can stick somebody in there before you pay that property off or refinance. Sorry.
Yep.
All right, this is our last question. This one's from Ryan. It says, based on the information presented today, which of these metropolitan areas would be best to invest now?
Well, I think it depends on what type of investment you're looking at doing. I think if you look at the data, it looks like Austin is probably the best flip market because the days on market are incredibly low and the prices seem to be going up at a higher percentage. That seems to be a great flip market. I do know that they have a lot more building codes and expectations, so you definitely want to be educated on what the expectations there, especially if you look at doing additions. But Austin, just looking at the numbers themselves, seems to be a great market. It is a higher price point overall, so it does require a little bit more money out of pocket and more money to cover interest payments and things of that sort, taxes. Whenever you look at the buy and hold market, I think both Houston and San Antonio had very strong numbers as far as rents and attractive price points. But as we build through the data, you know, the rents were significantly lower in San Antonio. So I might say Houston because it seems to be the best combination of the prices not being quite as low as San Antonio, because San Antonio is a lower price point. But if I remember correctly, the San Antonio average rents were $1,300, whereas they're $1,900 in Houston, and that's a very strong number. And we in this research we actually saw some data, which I would like to include next time, on the comparison between affordability of properties to purchase and to rent. And we'll try to bake in some of that data in our next presentation, because I do think that would be very telling as well. But just based on the high level numbers, that's kind of my feedback based on the data.
Yeah, I just flipped through. For those of you who were watching, you probably saw me on here, but the 1,300 was the rental price in San Antonio on average, and then Houston is 1961, so that's significantly higher. And one more question came in.
I do want to say one quick thing. In Houston, for our typical buy and hold investor, both ourselves and the people we work with, 1,900 is not the most common rent, but I think the typical deals that are the most profitable are under 225,000, maybe 250 in value, and most homes in that range are probably renting at that price if you're at the 225 range. But a lot of people are buying like those $180,000, $175,000 homes, and those rents are not quite 2,000. They're often lower than that. But,
Awesome. This question, and I apologize if I am saying your name incorrectly, is Lise, L-I-S-E. Thank you for asking. I believe the question is asking for tenant deposits for single family, but I'll go ahead and read the question now. Are you aware of other investors raising the deposit 2 to 3 months as opposed to the normal 1 month deposit because of the current economic situation?
I've heard of some people asking for enhanced deposits, but I think that is not always extremely easy to get. Once you start getting to 3 months, you're kind of getting into a range where you're not that far from a down payment to purchase a home, like on an FHA deal. So that can be somewhat difficult, in my honest opinion. Now, there are some other products which I think are very attractive, which are called, like one product is called a Rhino product, which is an insurance that you can have the tenant play to have an enhanced security deposit. So let's say you collect 1 month's rent, and then the tenant will pay an extra $5 a month, as an example. And then that gives you an additional entire $1,500 security deposit if for some reason things are wrong with the property. You do have to document them. There's a little bit of paperwork, but that can give you enhanced protection in case the home is damaged beyond what the normal security deposit is. But in my opinion, and I don't know, there may be some other people who figured this out. I'm not saying I know what everybody's doing out there, but theoretically, I think it might be hard to get a triple deposit. It seems like that might be tough.
I know what you're talking about, Wade. In the luxury apartments I worked at, we had something similar with sure deposit where the tenant would pay $50 and it would cover them for up to $1,000 in damage. So any damage we ended up charging back to the tenant, we charged through sure deposit, and they would go back to the tenant for it. But we would get reimbursed from that sure deposit. I mean, you know, and then the debt was then between the tenant and the third party. Lise, you're welcome. She said thank you. All right, and that hits it right at 1 o'clock. So we want to thank you guys for giving up your lunch hour and joining us today. If you have additional questions that pop up later after you review for the second time, maybe feel free to shoot us an email. We're always happy to help. Thanks again for joining us.
Thanks, everybody.
Thanks, everybody. Have a great day.